If you've ever wondered how the ultra-wealthy build their fortunes, you're about to get an insider's look. In this video, I'm going to break down a portfolio allocation that has been used by the top 1% to grow their wealth and achieve staggering net worths, around $13.6 million. That's the exact figure needed to be in the top percentile in the US. If you're serious about investing like the rich, stick around, because I'm about to show you how this strategy can help you build massive wealth over time. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Let's break down exactly what this portfolio looks like based on the High Net Worth Asset Allocation Report. The largest chunk of the portfolio, making up 54%, is in equities. Now, what does that mean? If you're new to investing, equities are simply shares or pieces of ownership in a company. So, over half of a high net worth individual's wealth is tied up in these types of investments. But it's not all the same. This 54% is divided into two different kinds of equity. First, there's 37% in public equities. These are stocks of companies that you can buy on the stock market, like Apple, Microsoft, and Tesla. Warren Buffett, one of the most well-known investors in the world, has about $280 billion invested across roughly 41 different equities. It's easy to see why someone like Warren Buffett, or even you watching this video, might choose to invest in the stock market. It has a solid long-term track record of delivering strong returns. To put this into perspective, let's look at some real numbers. Starting with $50,000 and contributing $1,000 each month, with a 2% annual inflation adjustment on those contributions, assuming an annual return of 9.8% in 20 years, your portfolio could grow to just over $1 million. Public equities make up just one part of that 54%. The other 17% is allocated to private equities. Private equity refers to owning a stake in companies that aren't listed on public stock exchanges. This could mean owning your own business, or investing in someone else's private business. Honestly, I had expected that high net worth individuals would allocate more than 54% of their portfolio to equities, but that's not the case. Next, let's look at the second largest portion of their portfolio, property, which makes up 27%. There's an old saying, you'll never go wrong investing in bricks and mortar. So how do ultra high net worth individuals use this strategy? Over the past 20 years, property prices in the United States have generally increased by around 4% to 5% annually. However, this can vary widely depending on the location and market conditions. In major cities and high-demand areas, growth was often much higher, while some regions saw slower increases or even declines, especially during downturns like the 2008 financial crisis. This figure only accounts for the property's capital appreciation, but it doesn't include rental income, which could boost that return by a few extra percentage points. The remaining 16% of property wealth is tied up in primary residence equity. This is the value of your home after subtracting any mortgage debt. It's important to note that owning a house doesn't automatically mean you're worth the full value of it. Your mortgage balance needs to be deducted first. Property, overall, is one of the most popular ways to build wealth, and I'd say it's a crucial component of any long-term financial strategy. It's not just about building wealth for yourself, but also potentially creating something to pass down to future generations. Next up, we've got the third portion of the portfolio with 14% allocated to fixed income. This generally refers to investments like bonds or other debt instruments that provide a fixed return. Essentially, you're lending your money to an organization, whether it's a government or a corporation, and in return, they pay you interest. Fixed income investments are considered lower risk, which is why they usually offer lower returns compared to equities. But the upside is stability, and they're often used to help balance out the overall risk in a portfolio. For high net worth individuals, this 14% serves as a cushion against the volatility of other asset classes. Finally, let's wrap up with the smallest portion of the portfolio. 5% is allocated to alternative investments. This could include things like hedge funds, private equity, venture capital, or even more unique assets like art, wine, or cryptocurrency. Alternative investments are generally seen as higher risk, but they also have the potential for much higher returns, which is why they make up a smaller part of the overall portfolio. Take crypto as an example. Many ultra-high net worth individuals are now incorporating Bitcoin and other digital assets into their portfolios, either as a hedge against inflation or as a bet on emerging technologies. But whether it's crypto or luxury watches, the key takeaway with alternative investments is to treat them as just that, an alternative. They should never dominate your portfolio unless you have a strong conviction or deep expertise in that particular asset. Before you go off trying to mimic this exact portfolio, there's one important thing to remember. These allocations are tailored for ultra-high net worth individuals. Their financial situation, goals, and risk tolerance are much different from someone with a smaller portfolio. For example, if you're just getting started, it might make sense to put more of your money into equities or an area of expertise like crypto. This will give you the potential for greater growth, even if it comes with more risk. On the other hand, if you're approaching retirement, you might want to shift toward fixed income or real estate to bring in more stability and lower risk. But here's the takeaway. It's all about the mindset. The ultra-wealthy focus on diversification, long-term growth, and owning assets that either generate steady income or appreciate over time. Whether you're investing a few hundred or a few million, those key principles apply across the board. So while the exact percentages may not be the same, the approach to building wealth is universal.